Well, let us get started. It is 10 a.m. Today is Tuesday, December 15th. I am Marina Parkin of Koontz Parkin, and today we gave Joanne Koontz a day off, but I am joined here today by Jackie Durham, who's an attorney of Koontz Associates. She's my trusted colleague and is here to participate on all things legal. So today we have quite an exciting topic for all of you, something that I can talk about for all week long if you don't stop me. We're going to be talking about rental properties. So we're going to cover some tax and legal aspects of a rental property. And the best way really to talk about rental property is in stages of the ownership. So getting ready and buying the rental property, owning the rental property, and then selling the rental property. So each one of those things I can talk about for a week. So Jackie's here to kind of stop me. And what I think we're going to do is get started and maybe break it up into two parts. We'll see how far we can get today, and we will bring part two to you as necessary. This is going to be our last webinar of 2020. It's been quite a year. It's been our year of beginning the webinars, and we're going to definitely continue them in 2021. We will be back on Tuesday, January 5th. So please join us at that time. We're going to have a lineup of interesting subjects for you, and bringing part two. As always, if you're interested in learning about other things that we may not be covering yet, please email us some ideas. You can post your questions in the Q&A box. We will be watching out for them, and whatever we do not cover today, we will answer next time, or we can email you depending on how specific the question is to your circumstance. So without further ado, let's get going. So let's talk about buying a rental property. So we're getting ready to buy a rental house. What do we do? What do we do? So I wanted to, first of all, bounce this off to Jackie, because when people come to me and say, oh, I'm gonna have a rental, what can I deduct? I always say, whoa, 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 whoa. Before we even get into deduction, before we get deduction happy, let's first figure out how you're going to own this rental property. Is it going to be under your personal name? Are you going to own it with your spouse, with your friend, with a bunch of other people? Are you going to own it under a legal entity? And I'm going to let Jackie talk for a minute about the importance of legal protection in acquiring a rental property. Jackie, if you can maybe bring on a couple of points on the importance of potential LLC.
Right. So typically we do recommend, if you're going to own a rental property, which cannot be, it's not exempt for purposes of homestead. You can't enjoy that homestead protection, which tends to be the greatest creditor protection in Florida. You definitely want to opt to hold it in an entity such as an LLC. The LLC has the most, what we feel to be flexible operating procedures and requirements, and it also has that asset protection and liability protection, which is very attractive to its owners. So what I typically recommend for a client who's coming in and they're going to be buying a rental property is to form a new LLC to hold that particular rental property. A lot of folks like to hold multiple properties in one LLC, or they like to reuse an LLC that, just for instance, sold a property and now they're going to use that same LLC to own this new rental property. I don't recommend doing that. And the reason is being, the whole point behind having an LLC is for the asset protection and the liability insulation. If you own multiple properties in one LLC, if there's an accident that occurs at one of the properties, now all of the properties owned within the LLC are going to be subject to attachment by a creditor. And likewise, if you reuse an LLC, you can still have trickling liability from the ownership of the previous property. Just because you've sold the property doesn't mean that there aren't issues that can crop up. So you want to make sure that you're creating a fresh new LLC for each property that you're going to hold, and that they're all held separately. Of course, when you form the LLC to hold the rental property, you want to make sure that you have the normal things in place that we always talk about, which is the operating agreement, making sure that this is prepared by an attorney, and more importantly, making sure that you operate your company in accordance with the terms of your operating agreement. If you don't have an operating agreement, you want to make sure you're operating in accordance with the laws of Florida, because the failure to do so is going to completely, it defeats the whole purpose of having the LLC and having that limited liability protection. Because if you don't operate properly like an LLC, you will not be treated as one by the courts, which will completely dissolve and deteriorate that limited liability protection. So another thing, once we get into the sort of operating the rental properties, we'll get into a few more specifics that an LLC, especially an LLC holding rental property, needs to follow as well once they're actually operating and renting.
That's absolutely perfect. And I also wanted to mention, we often hear, well, I already have an LLC. Can't I just buy my rental property in the LLC that I already have? No, please do not. Because again, you're subjecting yourself to potential liability of the items that are already in your LLC, particularly if you have an operating entity. I actually did have a client several years ago who understood the importance of LLC, and he had a couple of different companies, and he had a lot of rental properties. And he shows up with his tax return documents, and we're going through all of his rental schedules, and he said to me, oh, by the way, I refinanced a bunch of my properties last year. And I said, well, this is fantastic. And he said, you know, when I went to the banker, he said, since you're refinancing them and we're doing different closing documents, we might as well put your properties in the LLC. And I said, oh, this is fantastic. And he said, so I did. I put them in the LLC that I already have. Well, it was his operating entity where his active business was run out of. So, which was already treated as an S corporation, which is a big no-no for owning any rental real estate. So it was, again, no one called until they showed up for tax. And then we did get into a bit of an untangling exercise with him. But it's very difficult because when you do go through stuff like that and you talk to a banker, the banker, for example, or any other professional you're dealing with knows the importance of the LLC. They don't know your particular situation and how it may impact you. So before you make any decisions and you do get advice, do run it by your attorney or your CPA as well, so we can advise you better before you pull that trigger. So it's very important. The ownership is super important. And then of course, different situations will lead you into different things like, you know, should I own it with my spouse? Should I just own the LLC myself? And that will really depend on your individual circumstance. From tax filing standpoint, if you're gonna have an LLC that is a multi-member LLC, even if it's just you and your spouse, you are gonna have to file a partnership return to reflect the rental property activity. Of course, at the end, everything passes through to your guys' individual return. However, if you're just owning the rental property in your individual name, you form an LLC, it's considered a disregarded entity. And we covered that when we did the entity formation, which means that you don't really have a separate tax filing to do. You're just going to reflect that rental property on your individual tax return as just a rental schedule. So you're going to have a legal entity, you're not going to have an additional tax filing requirement. So it makes it easier and more efficient that way. Again, that's going to make your decision. Your decision should really be what's perfect for legal purposes. And then on the tax side, we will make sure that we reflect it in the proper filing. So now that we've determined we have our beautiful LLC and we are getting a rental property. So we do a closing. Again, very important. You actually have to have your LLC be the buyer of your property. And I feel like it seems kind of a silly thing to say, but time and time again, we see that the people form the LLC and they said, this LLC is going to manage my property. Well, what does that mean? It's going to receive rent and pay expenses. But then you just created a management company. You really did not create an entity that actually protects the particular property from anything else. So management company may be fantastic if you've got maybe multiple rentals or you're managing other people's rentals, but not having the property inside the LLC really defeats the purpose. So make sure that, again, we see that time and time again, and we have to talk to people about, now you actually have to do a title transfer. And in most of the circumstances, and Jackie, correct me if I'm wrong, you have to pay the doc stamp taxes again.
Well, yeah, not only the doc stamps, but let's not forget that right now with interest rates, a lot of people are obtaining financing. If you are racing towards the finish line because you have this rate lock and you're like, I'm going to go ahead and just buy this property in my personal name, and my lender or my mortgage broker tells me that I could just transfer the property after the fact to my LLC, not only are there going to be doc stamps that will be due, but you have to also keep in mind that your mortgage broker cannot offer you legal advice. And sometimes there are covenants that are contained within the loan documents themselves, which basically provide that you will individually be occupying that property. You can't just willy-nilly transfer title to your property when it's subject to a mortgage, because certain lenders have certain restrictions in place, and you may have to go and basically seek approval for that transfer. So it sounds very easy and everybody wants to race to the finish line, but you need to be careful and take the right steps to properly form that LLC to take title. And you need to make sure that you are communicating that to the lender. Even if the LLC isn't already formed, at least communicate that to them that you are going to be taking title in an LLC. It's really important.
Now, Jackie, what happens if you want to convert your current principal residence into a rental? How would you go about doing that? So you decide that, you know, this was my starter home. Now I have a bigger home, but this is a perfect rental. So I'm going to convert the use of my principal residence into a rental.
So in that case, what I would do is form an LLC, transfer title to the LLC, subject to seeking approval for any kind of restrictions that may be in place with your, loan documents, should it be subject to a mortgage. The other thing that you need to consider is, you're going to lose any kind of homestead exemption, but you do still have certain caps to the increase of the taxes. But just be prepared for the fact that when you switch gears like that and you go from a homestead property to a non-homestead property, they will reassess the property at the current day's valuation according to the property appraiser. So be prepared for that. The other thing I would say is you definitely want to make sure that no matter what, when you are acquiring a rental property, either in the name of an LLC or if you're transferring personal property to an LLC because you're converting it into a rental property, you absolutely need to get with your insurance agent right away to make sure that the right policy is in place for you, because a traditional homeowner's policy is going to have exclusions for third parties that may be occupying your property, because a traditional homeowner's policy contemplates that you are personally occupying that property. So make sure you get with your agent to make sure that you have the right policy in place. And that even extends to if you have like a vacation rental and you furnish that vacation rental, you need to make sure that you have the proper personal property protection in there for insurance purposes. So just make sure you're checking off all those boxes before you make the transfer and before you start collecting the rental income. Absolutely.
Do you need to do something special for the homestead? Do you need to notify the county, or will you automatically lose it?
Yes, well, they'll see when you transfer the property, because you're going to do that by way of a quitclaim deed, presumably. So they will see that, but I believe there are certain forms that you need to file to notify them. The other thing to keep in mind as well is, let's say you're converting your personal property to a rental property and you want to bring on a partner. So you're technically transferring the property from your personal name to your LLC that's held by you and another individual. That also is going to trigger doc stamps because of the change in beneficial ownership interest. So that's another tax that you need to be prepared for and that you need to plan for, in addition to the insurance planning and LLC formation and all that.
This just goes to show that nothing is easy. You really do need to consider everything before you do it. And again, I cannot stress enough about talking to professionals before you start doing it so that we can get you set up properly. Even advice on the insurance, we don't do insurance here, but we have seen enough to say, hey, you do need to call your insurance agent and please notify them. We just want to prevent any potential issues from coming your way and impart that knowledge onto you to make everything go smoothly so that you do succeed in this rental adventure. So, well, now we've bought our property, we have our closing statement, we've properly done everything, we've got an LLC, and so now we own it. So what do we do now? The first thing that I would say is we got to set up a system of tracking our revenue and expenses. Um, I am back into what's good. People ask all the time, bookkeeping, QuickBooks. Please don't do QuickBooks if you're not a bookkeeper. If you're hiring a bookkeeper, they will set up QuickBooks for you. If you have QuickBooks experience, please, by all means. But if you just want to keep track of your rental expenses and your rental income, just set up an Excel spreadsheet, and it's going to make things much easier. We have a sample spreadsheet that we can send out to those that are interested. It's got, your basic kind of categories for the rental expenses. You may be calling things a little different, and that's okay. You may want to detail certain things out more just for your own tracking, and that's fine. The system is meant to be customized by you, but the key is to have a system. And you're going to have a bank account where the rental revenue comes in and the rental expenses come out, and that's going to help. So I would say once a month or at least once a quarter, update your spreadsheet by month. And so at the end of the year, you really have a good total for what you've collected. It also really helps when we do tax planning, particularly if it's the first year of your rental property, where if that is going to make a difference in your overall tax impact, we want to make sure that we account for it, because there may be a loss that's helping you offset other income, or there may be some additional net income. And so that's why it may swing one way or the other. So it's important, the sooner you start the tracking system, the better. Just think of it as just like any other small business that you're running or starting. The record keeping system is great. So having said that, let's talk about what kind of rental is it going to be? Is it going to be a short-term rental? Is it going to be a long-term rental? Jackie, can you talk a little bit about the implications of the short-term rental from the tax and legal standpoint?
Yes. So in addition to the federal tax considerations that need to go into tracking the expenses and things like that, you also need to pay close attention to the rental terms, because in the state of Florida, if you have a lease or rental that is 6 months or less, you're going to have sales tax that is due. Sales tax is due on commercial rental, but we're focusing more today on residential rental. So in general, most people don't think of sales tax when it comes to these residential rentals, but if you have a shorter term rental that is 6 months or less, that sales tax of 6% plus whatever your local county surtax is going to be due. And in addition to that, there's tourist and development tax of 5% in addition to that sales tax that's going to be due on that. So the shorter the rental term, sometimes the more you're going to pay in that local tax. So you need to make sure you're paying very close attention to that. And I think that's also something that's beneficial for having a bookkeeper to track not only your expenses for federal purposes, but also these small local taxes. I shouldn't say small, these additional local taxes, because they have to be sent in on a monthly or quarterly basis. And you want to make sure that you're tracking all of those, because you can kind of get a little bit of a mess on your hands if not.
Absolutely. And I also do want to mention that if you are hiring a property management company to help you manage the rental, most of the time they will handle any of those tax remittances, but please double check. Don't just assume that it's being done. Please double check, and in your property management agreement, it should specify what their responsibilities are. But we want to make sure that all of those short-term taxes are handled. Particularly, we deal with a lot of the foreign investors when they come in and buy a rental and they go home. They spend most of the time in a different country, and they have a property management company here who oftentimes coordinates with us on the tax side. And we always want to double check that if they are doing a short-term rental, that the property management company is handling that. I also understand that if you are using Airbnb or those kinds of services, that I believe they also handle the remittance of collection and remittance of those sales and tourist tax. Is that right, Jackie? Have you come across it?
I believe so.
Mm-hmm.
But I guess I've just seen some clients get burned where they're not, they're trying to do it themselves. They're trying to save money, which I can completely appreciate. But you have to make sure that someone is doing this. Someone is collecting this and remitting it properly. And whether that's a third party or your bookkeeper or yourself, you just need to make sure that you're addressing those items. And speaking of those property management agreements, something else I want to raise my hand about real quick. Mm-hmm. That's a bit off subject, but I can't not mention this. Is you need to be careful because a lot of times these property management agreements are between yourself and a broker, a licensed real estate broker, and one of their licensed agents. And typically hidden in the fine print of those contracts is something that basically provides that if the property is sold during the term of this property management agreement, that they are entitled to a commission. So a lot of folks that I see that kind of procure their own buyer, whether it's a friend or a tenant, they tend to be a little surprised by this and the fact that, you know, the agent didn't procure this transaction for them, yet they're entitled to a nice little commission. And there's not much you can do about that once you sign it. And a lot of people overlook that part. They look at what the rate is for them to manage the property, but they don't read the fine print. So you need to make sure you take a close look at that with your attorney before you sign any of those agreements, because you could find yourself in a position where you need to sell or want to sell, and either the agent you're hiring to list and sell the property for you has to split that commission with your property manager, or if you sell it yourself, now you are taking a hit off the top based on that commission that's baked in.
That is an excellent point, Jackie. Everything that you do like that absolutely has to be reviewed and determined. And the other thing I have to say about the property management, and we work with quite a few property management companies, and there's a responsibility that they have of tracking certain things that they pay for. The other thing that you really do need to make sure that you know what it is that they're responsible for paying versus what you need to do on your own. A lot of times when I prepare a tax return and they say, well, the property management is handling my reporting of the income and expenses, and so just get a report from them. And I contact them and then they send me a report. And then I see that, you know, they've hired a plumber to fix this. They've hired, you know, electrician to fix that. But a lot of times you may be spending money out of your own pocket thinking it is going through a property management company, and it's not. So it's going to be important to really capture all of the expenses. Sometimes the property management company does not pay for these things. They're really in charge of just collecting the money, and you know, then you're responsible for paying for the labor of doing stuff like that. So it's important for when we collect the information is really to capture all of the expenses that you spend on it. And we'll get to the expenses in a few minutes here, but I think that having a good understanding with what is the property management company doing for you versus what you're doing on your own is important. So let us get into kind of the meat and potatoes a little bit on the what is the rental income and what are the rental expenses. So what's rental income? Well, it seems like it's kind of self-explanatory. Well, I collect rent from my tenant and that is rental income. And that is all correct. So let's talk about things that may not be as clear cut. For example, a deposit that you receive from your tenant. Is that deposit, so let's say you received first last month, is that deposit income, or is it not income until the tenant has lived in there for the last month? Well, the rules are in such that if you have to refund that deposit, then it's not considered income to you because you actually haven't technically earned it. You will earn it when the tenant's stay in the rental property expires, and then you may refund it or you may not refund it based on conditions. So when those conditions are met, then if you got to keep that deposit and didn't have to refund it to the tenant, then you get to keep it. However, if that deposit is unconditional, in other words, it's a non-refundable deposit, and no matter what happens or how long the tenant stays, you get to keep that deposit. It becomes the income in the year that you received it. So oftentimes your rental revenue is not as simple as monthly rental times 12. It may be times 13. There may be a flat deposit. So you really need to look at the terms of what those deposits are and treat them as taxable accordingly. The other thing that I think catches people sometimes is the services. So you may be renting the property and then your tenant may say, well, in lieu of paying you, I am just going to fix the property or mow the lawn or do renovations on it or paint it or stuff like that. Well, the fair market value of the services that you receive are considered rental income. And that, I think, oftentimes goes unnoticed, and I haven't come across too many cases, you know, in my experience where we've had to talk to the client about really calculating it. It hasn't really been a lot, but I feel like and maybe 2020 is the year to make sure that we tell folks about it. But maybe people are staying and they cannot afford to pay rent, and you cannot kick them out. But instead, they're going to say, "Well, I'm going to do all of this labor for you." The fair market value of the services provided do need to be included as rental income. So that's important to understand. Any other things on the rental income, Jackie, that come to mind?
If we're getting into the collection of rental, I think one of the
We definitely are. Yes, we are.
if we're at that stage, yes, I have a few things to share. Jumping back a little bit to the proper operation of your LLC holding company. Marina mentioned that you need to make sure you have a bank account where the rental income is coming into, and presumably where the expenses are coming out of. So it's really, really important that you maintain a separate bank account for your LLC holding company, and that you are not commingling funds between other LLC accounts or your personal account. That is the quickest way to put a chink in your armor from an LLC protection standpoint. I see this all the time, especially when we have a property holding or an LLC holding multiple properties where we have rental income coming in from all these different properties. That's going to be that much muddier. And also, even if you do it the right way and you have separate LLCs holding each individual property, sometimes we see people using their personal credit card to cover expenses for the property and things like that. You need to make sure that you are not doing these things, because it really will compromise that liability protection. And you need to make sure, of course, that you have that operating agreement, that you're governing in accordance with the operating agreement, and taking all of those proper steps to act like you are truly a separate entity. And then the other really important item is to make sure that you have a nice, tight rental agreement that is prepared or reviewed by your attorney. That is absolutely critical, because it's going to dictate these important terms. And assuming everybody pays when they're supposed to pay and everything goes according to plan, you don't really have to dust off that lease. But at the time when you do have to dust off that lease, you're going to be really happy that it's nice and tight, because it's akin to an insurance policy. You don't need it until you need it, but when you need it, it better be good. So it's really important. The ins and outs of what belong in that rental agreement is for another discussion on another day, because I could talk for 4 hours about it. But that's obviously a very critical part of this process to protect yourself. And it's best to have that in advance of having your first tenant in there. I see a lot of folks that want to get that tenant in there right away, and they're like, I'll put the lease agreement in place later. And I think that's a mistake.
One other thing I did want to mention also about the tracking of the income. So if you are, let's say, funding the bank account, you know there's repairs coming up, so you've transferred some money from personal to the business. That's not considered rental income. Same thing on some of those deposits that are not going to end up being rental income. If you do have a bookkeeper helping you, please tell them, give them some detail, because sometimes when we get the reports from the bookkeeper on the rental property, and if they look at all of the deposits in the bank account and they say that's all rental revenue, if some of those were just you funding the bank account, or you transferring some of the deposits or moving money back and forth, that's not really rental revenue. So we want to make sure that we do not overstate that rental revenue for you, and so you just need to communicate and have some detail to the bookkeeper about what is really revenue and what is not. So that's also going to be very important. Let us get into some of the expenses here. So the rental expenses are kind of self-explanatory, and like I said, we do have them on the spreadsheet if you guys so desire. I'm going to run through just some of the basic things that are very typical, and then we'll talk about some of them in a little bit more detail. So we've got, of course, our advertising, we've got our association dues, if there's association where the rental property is located. We have our cleaning, maintenance, we have commissions if you've got a property management company. We've got lawn care, pest control, just general maintenance, pool service, stuff like that. You have your insurance. that you're paying for the rental property, all types of insurance on it, legal and professional fees. So fees for us to do the tax return, for example, or for the lawyer to look at the agreement, those are definitely deductible. Any licenses or permits that you had to get for the property are also deductible. Management fees kind of go with the commission sometimes, but sometimes they're separate. If you don't have a property management company, you may still have somebody who, gets a management fee for maybe bringing you a tenant and stuff like that. You've got mortgage interest. So if you borrowed money to buy this rental property, you can deduct the mortgage interest. Keep in mind, you're not deducting the payment, the full payment to the mortgage. We'll get into how you write off the cost of the actual property, but the interest on the mortgage is deductible, as well as the qualified mortgage insurance premiums. You've got your painting, your decorating, your kind of general repairs. You've got your plumbing and electrical repairs, any supplies you're buying for it. Of course, real estate taxes, any other taxes, as we discussed, if you had to buy any taxes on purchases of supplies. And then if you are paying utilities, if you're paying telephone, if depending on the agreement, what it is that you're paying for, that is all going to be deductible. So there's some other things that I wanted to get into a little bit more detail on. For example, depreciation of the cost of the rental property. This area, like Jackie said, I can talk about for 4 hours, just that. So people say, well, I'm paying this in the mortgage. Am I not deducting the mortgage? No, you borrowed money to buy the rental property. And the way we're going to deduct it is not deducting the mortgage payments, but deducting the actual cost of the rental property. Now, you cannot deduct the cost of purchase of the property all in the first year. The way that we would do a rental property is we will take the rental property, the cost that you paid for, we have to allocate it between the land and the house. Typically, we use the allocation suggested by the county where the property is at, because the county, when they do evaluation, they do suggest of how much they think is land versus building. If you have a better idea on the allocation, maybe you had just done a survey or something like that, then you can definitely suggest it. Most of the time, using the county split is pretty good. So we would split the land. The land is a non-depreciable asset, so you cannot write off any depreciation on the part that is allocated to the land. The house is. If it is a residential rental property, it's 27.5 years. If it is a commercial rental property, it's 39 years. So you've got your actual house that you can now start writing off over 27.5 years. Now, what is included in the cost of the purchase? That's where it's important to provide us with a closing statement. On the closing statement, it's typically 2 pages and it has a bunch of line items. And you say, well, it's in a county record. The only thing that gets recorded in the county record is the actual top line of what the agreed upon contract price. But you've paid a bunch of other things. There may have been closing costs related. You've paid for dock stamp taxes, and then you've paid some legal fees. And then you've paid some, maybe you did the appraisal and you paid for that. So depending on what falls on your side of that closing statement, because that also is up to negotiation. Sometimes the seller pays for certain things, sometimes the buyer does. So it's very important for us to have that closing statement, and anything that you had paid for gets included in the cost of the property. And then what we do is we take that total, we split it between the land and the house, and we depreciate the house. So of course, the higher the prices, the more depreciation you get. So it's very important to provide us with a closing statement and all pages of it. All pages that have the numbers are what's important to me, really. So that I definitely wanted to mention that the closing statement, because that seems to be the thing that people lose the quickest. I know on our side, when our law firm does the closing, there's all these packages and we do things electronically and we give a big packet by paper, and then we turn around and 2 months later, we ask people for the closing statement. Of course, we have a copy of the closings that we've done, but if in a similar situation they closed elsewhere and they come in, nobody can find it miraculously. So it is very important when you have it, if it's going to be the rental, that you put that together in your tax file. if you are converting your principal residence, as we discussed, into rental property, well, you're not going to depreciate the original cost that you bought your principal residence for. So what the amount that you're going to start depreciating is whatever is the value of the house at the time it became a rental property. Again, the valuation is, sometimes you may have a good idea of what the value of the property is. Sometimes the easiest is just to go in the county and see what they had valued it at, and then we set it up for depreciation. But it's definitely important to, even if you convert, to start taking depreciation. Now, let me say one thing about depreciation. People always, sometimes people say, okay, great, it's a great expense and I'm going to depreciate the stuff. But, well, if I depreciate it, doesn't that reduce the cost of my property? So when I sell it, I have a higher capital gain. That is correct. All of that is correct. So you start out with the cost of the property that you purchased, and then we start depreciating, and whatever is the adjusted cost at the time of sale is what goes to figure out the gain. And so people say, well, I don't want to reduce it because I don't want to have to pick up a higher gain. Well, unfortunately, you have no choice. When you go to sell the property and you go to report this on the tax return, the IRS goes through a formula of calculating your gain. And the way they word it is that the depreciation is allowed or allowable. Meaning, if you haven't taken the depreciation, you could have, you chose not to, what it would have been had you taken it, it will reduce the cost of your property and still calculate the bigger gain. So if that's the case, you might as well depreciate the property and take advantage of the depreciation. The depreciation expense is great because it reduces your potential taxable income at your ordinary income rates. In the meantime, when you calculate the gain, based on that adjusted cost, the gain is taxed at a lower rate. So actually taking the depreciation is a better expense because it does help you at a ordinary income tax rate, which at this point in our lives is higher. So it's definitely a good expense to take. Let me also talk about the other things like improvements, repairs. I mentioned the repairs are deductible. What is a repair? What is an improvement? What is supplies, and how we do that? This subject has also been kind of put on its head in the last several years as the depreciation rules have been changing, but also several years ago, there was a new repair and maintenance regulation. And it sort of twisted upside down the way we had always been taught to think about improvements. So in the past, the rule was, just the basic rule is that if you're doing something to the property that's going to improve the value of the property, and it's something that's going to last over a year, then it's not deductible. It's a capital asset. You have to set it up and you have to depreciate it. Well, the repair and maintenance regulations came out and basically said that you have to look at the property as a whole and you have to see how big of an impact this improvement makes. Even if this improvement lasts for several years, if in the grand scheme of the value of the property, it's not a huge an amount, then it's just an expense. If it's something that becomes part of the property, it's to what extent is it really improving the property? Or is it replacing something back to its original usable value, in which case, again, it's not going to be an expense, an improvement, it's an expense. The biggest thing that usually sort of gets people knocked off their head when we talk about the roof. So in the past, if you had a bad roof, it was leaking, it was terrible, you put a new roof on, it was considered an improvement. I have a new roof, it's going to last me 15 years or 27 and a half years till the end of the life of this house. However, the repair and maintenance regulations say that if your roof was in a terrible condition and all you've done is replace a roof back to its usable value, it's actually considered a repair. So you can technically deduct the cost of the roof if that roof was not really getting a better roof, it was getting a normal roof, a roof that you can now use and live under. So those things are all very, very gray. And what we have to do is when you come in for taxes, we have to look at the improvements that you made and say, what did these improvements due to the property. The other common example I like to use is the window replacement. So if you replace one or two windows, it's, you know, in the grand scheme of the house, it's not a huge amount compared to the overall value. You can deduct, you know, 2 or 3 windows. But if you went and replace all of the windows in the house, it's likely a capital asset that we need to possibly capitalize and depreciate. So it's just really, you know, we kind of have to look at it in the grand scheme of things and see what benefits you, where we can sort of make different decisions, and how much money you spend. So when it comes to record keeping for these items, we want to make sure that you give us as much detail as possible. We don't necessarily need to see the receipts, but please do keep the receipts. And I will get into the record keeping after this discussion. But so just keep any of those improvement and big repair receipts, and we may want to ask them just so we can read the description of what your general contractor has done to determine what's the better treatment and what's the more proper treatment. So I guess the big picture of it is that you can now deduct a lot more things than you were able to do so in the past. And I think the idea here was that the landowners and you know, the landlords are able to take advantage on the tax side from buying these rental properties and to match the deduction a little bit better with the timing of when the cash was spent. So if you bought this rental property, and yes, you got to depreciate that over time, but let's say you've painted it and you've replaced a bunch of things and you've improved it and you've spent all of this money, you should be able to get the tax break in that year. And the depreciation rules themselves have also moved in that direction, where we talked a little bit about, I think it's last time or the time before, about the improvement. Again, that used to be like a 15-year type of asset if you do qualified improvements to the properties. However, now you can even elect to do a bonus depreciation and be able to write off 100% of those improvements all in year one. So here we're looking at things like, was it structural? So did you increase the size of the property? Did you do something major? Did you add a story, or, you know, you expanded it? If it's structural, it does become the 27.5-year property that we talked about. But if it was something more remodeling stuff on the inside that does not affect the structural capability of the house, a lot of those things can now be elected to be depreciated all in year one. So we kind of look at those things. We also, because we have a choice in a lot of that depreciation selection, we look at, well, what are you expecting the income to be? Maybe in the first year when you buy the property, you may have only bought it, you know, closer to the end of the year. Maybe you only collected 1 month of rent. You really don't need those big deductions all in year one. Well, maybe you do, but maybe we want to push them into the following year where you're going to have a full year of rent. And then we can say, hey, instead of writing it off this year, maybe we write it off next year. That also is a big part of tax planning, because we can look at the timing, and sometimes when it comes to these renovations and improvements, our choice can be, well, when was it really placed in service? So if you are not placing something in service until the following year, that's a perfect time to start writing it off. If you've placed it in service and there's a tenant in there, then we write it off this year. So there's just a lot of considerations on, you know, the deduction of improvements, maintenance, repairs, capital purchases. And I think the key there is just to talk to somebody and really keep really good track of it. Jackie, questions or any comments about this?
Yes, we do have a few questions, but before we jump into those, I just wanted to make mention of these kinds of repairs that may be needed or improvements to the property. This is also where a lot of companies will fall into a trap where they contract for certain services or repairs or improvements in their individual name. Which is a big no-no. And the reason why this is particularly dangerous is because many times the injuries that are sustained on a property arise from workers or servicemen that come onto the property and actually perform improvements or repairs on the roof or elsewhere. So, you know, that's where you see a lot of unforeseen injuries that arise. And if you have contracted for those services in your individual name, now you are going to be personally liable for those injuries. and those damages, even though the property is titled in your LLC. And in fact, you both could get tagged for liability. So now that person is going to be coming after not only your personal assets, but your LLC assets. So your rental agreement, literally everything you sign, every kind of agreement you enter into for utilities, whatever it may be, you need to make sure that that is in the LLC's name and not your personal name. If you buy it in your personal name and later transfer it, just make sure you transfer all those contracts and update the company name. And one other thing I meant to mention before about the bank accounts, some people will put the part of their company's name as the title of the bank account. You need to make sure that unless you have your entity registered with a fictitious name that does not include the little LLC on the end, you need to make sure that your bank account is held in the name of your exact legal entity's name, exactly as it's registered on SunBiz. That's very, very important. You want to make sure you're not operating out there under a shorter name than what is registered with the state unless you have it registered as a proper fictitious name. We've gone into all those details before in prior webinars. And then one more quick thing that I want to jump back to as well that I meant to mention is, this seems kind of obvious, but when you're going to buy the property and you know you're going to use it as a rental property, and that is the basis for your purchase of the particular property, you want to make sure that you're making yourself, you're educating yourself on any kind of the restrictions within the condo or the HOA with respect to that rental. I've also noticed that can happen to clients who unknowingly step into these restrictions and they're not able to market and ultimately derive what they mapped out on their pro rata for that particular property. So just be careful about that as well. Make sure your attorney's taking a look at that before you sign on the dotted line at the closing table. And Marina, we have a couple of questions. Yep. These are all tax related questions, so I don't really feel that I should answer these, but
yes, I definitely, I've been kind of taking a look at them and wanted to Pressners, yes, I wanted to address that's a perfect example. So the question is, if in the rental, if you replace flooring from carpet to tile or laminate, is that considered an improvement or repair? This is a perfect example where we would kind of look and say, hey, was your carpet even usable? If your carpet was crappy and we just needed to replace something to make it usable again, then I would say that's all a repair. If your carpet was good, but then you decide to improve it and put a better floor, then that would be an improvement. However, we could take that improvement and take 100% depreciation on it. So instead of writing it off as a repair, we just take 100% depreciation of a capital asset. So you're still getting your 100% write-off in that case. But that's a perfect example. Couple of questions. There's a question about a self-directed IRA. We don't file any sort of tax filings. Those are usually done by the company who is managing your self-directed IRA. I believe it's $5,500 that they have to file for that, if I'm not mistaken. But so that would definitely be a question for the I think the custodian a bank who had helped you set up the self-directed IRA. But another good question from the same individual is about the travel expenses and some of the other expenses. And that's a perfect example of kind of expenses I wanted to get into next. So the expenses that I kind of fired off earlier were all about just your actual typical rental expenses, but you've got some mixed use. So you're traveling to check on your property, whether your property is maybe in a different state, or maybe it's, on the other coast of Florida, and you travel back and forth. You may be flying, you may be driving, you may be renting a car to get there. The costs of traveling to check on the rental property are deductible for sure. If you're using your car to drive, you should be tracking mileage, and then we can deduct that mileage on the tax return as the business expense. If you're flying, and let's say it's a vacation and you're going to check on your rental property, but you're bringing your kids with you because it was a vacation anyway, then the cost of your travel can be allocated to checking on the rental property. When it comes to stuff like that, I would certainly be reasonable in our allocation, because you cannot say that your whole entire family needed to fly there 3 times a year to check on it. So we may just use some reasonable allocation to say, did you do work on the property and how long you spent there, and was every single trip related to it? So we want to be reasonable, but just know that we can certainly capture a lot of those expenses. Same thing for the telephone. If you've got a cell phone that you're using and you're the one who is getting the renter set up. You don't have a management company, it's just you. So you're getting the renters, you're going to show the property and all that stuff. And you're, of course, on your cell phone quite a bit. You may be using your internet. I would certainly be able to capture part of your cell phone use. Again, be reasonable. If you're using, 25% of your phone maybe for the rental activity, then we'll take 25%. Just, be reasonable in the allocation. And so we've got the travel, we've got the kind of the phone. Home office is another common one. If you've got a lot of rental properties to the point where it's not just, you're not a CPA with one rental house, you may be managing 4 or 5 rental properties, and that's a main part of your job. You are able to capture the home office. If you've got some dedicated space in your home that you're using for record keeping, tracking everything, you've got a desk, please, the home office expenses, we had covered them before in an other webinar on just business expenses, but real quick recap, you're taking the square footage of home office over the total square footage of your home and allocate your home expenses. So we definitely want to be able to capture things like that. One very, very important thing that I want to mention, because I get this question all the time. If you as the owner do work on the rental property, the value of your labor is not deductible. It is not deductible. Doing work on your rental property, the value of your labor is not deductible. What's deductible is going to be, again, you traveling to the rental property to do the work, you buying supplies to do the work, but definitely not your actual time in doing the work. So that is most certainly. So again, I think you've got the common theme here in the deductibility of expenses is we got to be reasonable, we got to track it. Now, another question that I get all the time is, do I need to keep the receipts? Everything is on my credit card. And here you go. Jackie just told me I have to have a dedicated bank account and a credit card. So isn't that easy? Well, yes, but you should keep the receipts. You don't need to keep the original receipts. You should have a system where maybe you scan them and then you have them in PDF. IRS doesn't need to see the original receipts, particularly if you've got, speaking of repairs and maintenance, you go to Home Depot, those things disappear in 3 months. By the time we get to tax return prep, we look at those receipts, I can't see anything. So if you do have an ability to maybe take a picture with your phone, there's a lot of apps out there now where they take a picture and scan it and it creates this fancy file. That would be absolutely amazing if you can do that. Credit card statements, yes. Sometimes that, you'll have Home Depot and that's great, but stuff like that, it really depends on the IRS agent who may be doing an audit. If they see a lot of Home Depot, if they don't, really see what it is, they may say, well, it may have been your personal house, or why is there so much? And, this house is brand new. It just depends how they go, how nice of a guy he is, or vice versa. And so you really want to make sure that you've got those receipts. And if you do go to Home Depot, please put on there that it was for your rental property and the expenses are going to be reasonable. The other thing too that I wanted to mention along with the travel was the meals. Same thing. If you do travel to check on the rental property, and if you do spend, days here and there driving around for it, please, and you can have meals, so that's a reasonable expense. Again, please keep the receipts, and on the receipt you mark that it was a meal relating to you dealing with the tenant or traveling on the rental property. When it comes to mileage, please have a mileage log for it, and so it's at least we're able to reasonably capture that. So it's there's always a lot of questions, and I'm getting quite a few requests on emailing that spreadsheet, so I will send that. But if you guys want to shoot me an email, I'm at marina@koontzparkin.com, and just say please send me the rental organizer, I will, and you can start tracking. So we're kind of getting to the top of the hour. I know there's a few other questions that we can address, and I think what we will do is in part 2, I wanted to pick up where we left off, which is kind of wrapping up on what happens if you've got rental income or rental loss, is it deductible or not, and who gets to take advantage of the rental loss and who doesn't, and then getting ready to sell the property. So I think that should be a very nice part too. Last couple of questions. Jackie, how long does it take to set up an LLC? That's a good one. I figured you'd be perfect to address that.
Well, it really doesn't typically take that long to actually file with the state and register your name. Right now, though, the state is so backed up that it's taking weeks for the registration to be complete. And until it's complete with the state, you can't open your bank account, and you really can't get the ball rolling, so to speak, until you're an active entity with the state. But in terms of hiring an attorney to put all the other steps in place, like your written consents and your operating agreement, getting with your insurance agent and all of that other stuff, you can be doing that in the meantime while you're waiting for the state to issue the approval of the registration. So that aspect of it really does not take much time. So, and there's also over in the webinar chat section, Marina, a couple of questions that I just noticed. There's the first is from Joyce, and it's saying anything different for a condo vacation or second home from what you have stated. I will say from the legal standpoint, it's a little bit different because you're not renting it. I'm assuming that you're not renting it to third parties. You're just using it as a second home. I still recommend that that's held in an LLC. And I still recommend all the other things I've mentioned during the webinar about making sure any contracts you enter into are entered into under the name of your LLC. And it's also still good to hold a separate bank account and to fund that bank account with any money that you will need to make expenditures and repairs and replacements on the property itself. So if the account's down to $500 and you have a $2,000 repair you need to make for the roof, you as the individual owner or you and your co-owner need to transfer funds to your company account, and then the company account needs to cut that check to the roofer. So it's no different from a rental property versus a second home in terms of how you need to govern your LLC in accordance with your operating agreement and things like that.
Actually, there's, Maria, thank you for sending the question about the minimum amount of days. In part 2, I will also have a section about the vacation rentals, because we are kind of touching upon that, and that gets quite hairy. But what I do want to mention, there's no minimum amount of days that the property is a rental, but know that if you are splitting the use between you, let's say you're renting your house out, generally speaking, if you're renting your house out for less than 14 days, you do not need to include the rental income or track rental expenses. But if you are renting your house out for more, then you need to start splitting some of the expenses and reporting the income. Vice versa, if it's a vacation home or if it's a rental and you're using it personally, depending on the number of days that you use it personally, you may have to separate the expenses between personal use and the rental. But generally speaking, if you've got a property and it may be sitting empty, or you may use it and then it's rented for a couple of days, Airbnb or so, there's really no minimal days. It's just a matter of how you allocate the expenses to the rental property. But just generally speaking, to know that when the property is placed in service and is available for rent, you don't necessarily need to have a tenant in there for it to be considered rental property. If you're advertising it, it may be in between tenants, it's available for rent and ready, it's considered rented for the purposes of expense deduction, so you don't need to prorate that. But I will also touch upon that as we get into the vacation rental rules. So I think we've got a pretty good lineup, Jackie, for part 2.
I do. I have one more thing to add to what Marina just said. The 14 days or less rule, that's federal. That's not local tax. So that applies to the federal side of things. The local sales tax, the tourist and development tax, even if you just rent it out one day, you're still going to be subject to that tax locally. So keep that in mind.
Yeah, excellent point. Well, this is fantastic. Hopefully we've sparked a whole lot of interest in the rentals. And I think our goal too was to kind of impart to you guys how important every single step of this is. It's not necessarily just as easy as, okay, collect the money and pay your expenses. There's a lot of tricks and traps in every single one of those stages. So when we will bring you part 2, we will put that on the schedule, and we'll kind of outline some of the things. But what I do, like I said, want to cover is the vacation rental rules, the rental income or loss, what happens to that, and then getting the rental property ready for sale. Just wanted to wish you guys super happy holidays. Please take a little time to relax. It's been an exhausting year for everybody, and we will be back on Tuesday, January 5th, back and ready to start 2021. So thank you so much, everybody, for attending, and we will see you in the new year. Thank you.